Good morning/afternoon, everyone. I'm excited to welcome you to this presentation on comprehensive sales and revenue auditing. Today, we'll dive into how to ensure accuracy, compliance, and integrity in your financial reporting. We'll explore everything from auditing processes and risk management to the tools and best practices that can help make your audits reliable and effective. Let's get started on this important journey to strengthen your financial oversight and build trust in your reporting. Sales and revenue auditing is essentially the careful and systematic review of a company's sales transactions and revenue streams. The goal here is to make sure everything is accurate and aligns with established accounting standards. This process covers a wide range of areas, including examining sales records, contracts, billing procedures, and the internal controls that support these activities. At its core, the main objective of this audit is to uphold business integrity by confirming that the revenues reported are complete, valid, and recognized correctly. This is crucial because accurate sales and revenue audits lead to trustworthy financial statements, which in turn help build confidence among stakeholders. Ultimately, this auditing process not only ensures precision but also guarantees that the organization complies with the relevant accounting standards throughout the entire sales and revenue reporting cycle. Auditing sales and revenue is crucial for several reasons. First, it ensures financial accuracy by validating that the reported sales figures are correct, which is fundamental for reliable financial records. Second, it acts as a deterrent against fraudulent activities, like fake sales, helping to catch any dishonest practices early. Third, it supports regulatory compliance by making sure the organization follows all relevant accounting standards and legal requirements. Fourth, it protects the company's reputation and maintains the trust of investors, which is vital for long-term success. Finally, all these efforts combined help safeguard the organization's overall financial health and legal standing, ensuring it remains strong and compliant in the marketplace. When we talk about the key objectives of sales and revenue audits, there are four main goals to keep in mind. First, it's crucial to detect any errors, discrepancies, or even fraudulent transactions within the sales records. This helps protect the organization from financial misstatements or potential losses. Second, we evaluate the effectiveness of internal controls related to sales processes and revenue recognition. Strong controls reduce risks and improve the reliability of financial information. Third, we verify that revenue is recognized properly and in line with the relevant accounting standards. This ensures that revenue is recorded completely and at the right time, reflecting the true financial position. Finally, by achieving these objectives, we help ensure that the financial reports accurately reflect the organization's performance, giving stakeholders confidence in the numbers presented. When we talk about the auditing process, it starts with planning. This is where we define the scope of the audit, set clear objectives, and allocate the necessary resources. It's also crucial to understand the business environment and identify the key risks that could impact financial reporting or operations. Next, we move into risk assessment. Here, we analyze areas that might be vulnerable to significant errors or fraud, so we know where to focus our efforts. Following that, we perform audit testing. This involves carrying out both substantive tests and control tests, which can include sampling transactions and carefully reviewing supporting documentation to ensure everything is accurate and compliant. Finally, in the reporting phase, we compile our findings into a clear summary. We highlight any issues we discovered and provide recommendations for corrective actions to help management improve controls and processes. This structured approach helps ensure the audit is thorough and effective. When it comes to collecting data effectively, it all begins with gathering the right source documents. These include sales invoices, contracts, shipping records, and receipts. Having accurate and relevant documents ensures that the foundation of our data is solid. Next, we use data analytics to validate this information. By analyzing the data, we can spot anomalies, identify trends, and catch any inconsistencies early on. This helps us maintain the integrity of the data. Another crucial step is reconciliation. We compare sales data against entries in the general ledger as well as cash receipts to make sure everything aligns perfectly. This process helps us catch errors or discrepancies that might have slipped through. Finally, when needed, we confirm sales with third parties. This third-party confirmation acts as an additional layer of assurance, verifying that the sales reported are legitimate and accurate. These combined techniques help us ensure robust and reliable data collection and validation. When assessing risk in sales and revenue, it's important to be aware of several common pitfalls. One major risk is fictitious sales, where fake transactions are recorded to make revenue look higher than it actually is. Another key issue involves revenue timing. Sometimes revenue is recognized too early or too late, which affects the accuracy of financial reporting. Finally, errors in sales returns and allowances can distort the true net revenue, making it either overstated or understated. As auditors, we need to carefully examine these areas to ensure the revenue figures are reliable and accurate. One common issue we see is unauthorized discounts and sales adjustments. These can distort the reported revenue by making it appear higher or lower than it actually is, which misleads stakeholders. Another problem is channel stuffing, where companies ship excessive products to distributors just to inflate sales figures temporarily. This practice can create a false sense of growth but usually leads to complications down the line. Revenue leakage is also a significant concern, occurring through billing errors, unrecorded sales, or incomplete invoicing. Essentially, money that should be captured is lost or overlooked. Recognizing these red flags is crucial for auditors because it allows them to pinpoint vulnerabilities early and take corrective action before the issues escalate. When it comes to auditing, there are a variety of tools and technologies that make the process more efficient and accurate. One of the key tools is ACL Analytics, which is an advanced data interrogation and sampling tool commonly used in modern sales and revenue audits. It helps auditors dig deep into large datasets to identify trends and inconsistencies. Another essential tool is Microsoft Excel, which many of us use for data manipulation and preliminary analysis during audits. Its versatility makes it a go-to for organizing and examining data before moving into more complex tools. Additionally, ERP-integrated audit modules play a significant role by streamlining transaction tracing and validation directly within enterprise resource planning systems, making audits faster and more seamless. Lastly, AI-powered solutions are an exciting emerging technology in the audit field. These tools can detect subtle anomalies and patterns that might be missed by human analysis, adding a whole new layer of insight and precision to our audit work. Together, these technologies significantly enhance our ability to conduct thorough and reliable audits. In this case study, the audit team discovered inflated sales at a mid-sized manufacturing company caused by recognizing revenue too early. To get to the bottom of it, they performed detailed transactional testing, which revealed mismatches between shipment dates and invoice dates. Based on these findings, the auditors recommended stronger cutoff procedures and additional training for staff to prevent future errors. After these changes were implemented, the company saw more accurate financial statements and significantly lowered its risk of facing regulatory penalties. This example really highlights how thorough auditing and effective recommendations can drive meaningful improvements. When it comes to best practices for auditors, there are 4 key areas to focus on. First is thorough documentation. It's essential to carefully record all procedures performed and findings observed, so that conclusions are well supported and transparent. Next, maintaining professional skepticism is crucial. Auditors need to constantly question assumptions and be alert to any potential biases or inconsistencies that might affect the accuracy of the information. Third, continuous training is vital. Staying up to date with the latest accounting standards and emerging fraud schemes helps auditors remain effective and vigilant in their roles. Lastly, effective client collaboration plays a big role. Building a strong working relationship with clients allows auditors to gain a deep understanding of their business processes, which in turn improves the quality and relevance of the audit. Together, these practices ensure that audits are thorough, reliable, and responsive to changing environments. Accurate auditing plays a crucial role in building trust and confidence among investors, regulators, and customers, which is essential for any business. It ensures that the financial information presented is reliable, helping management make well-informed decisions. Additionally, accurate audits help organizations stay compliant with legal and contractual requirements, avoiding potential penalties or disputes. By identifying and minimizing financial misstatements and operational risks, auditing protects the business from costly errors. Ultimately, all these factors work together to support sustained growth and enhance the company's reputation in the marketplace. Sales and revenue audits play a crucial role in maintaining financial integrity and ensuring compliance with regulations. They help organizations verify that their financial processes are accurate and transparent. To enhance the effectiveness of these audits, adopting risk-based and data-driven approaches is key. This means focusing on the areas with the highest risk and using data analytics to uncover potential discrepancies. It's also important to conduct audits regularly and implement continuous monitoring. This proactive strategy allows organizations to quickly spot and address any issues before they escalate. Finally, investing in skilled audit personnel and advanced technology is essential. Such investments not only improve audit quality but also provide ongoing protection of revenue accuracy, ensuring the organization remains financially healthy and trustworthy.